Aaron,
Tim, how's it going?
it's going well. I'm excited. We've all been hearing a lot about the one big beautiful bill, and as big as it is, there was a lot in it, and I think there's some exciting topics to talk about.
Absolutely, yeah. Let's dive into the material we got here because there's quite a bit to go over.
Yeah, the one thing that I do want to make sure that everybody understands is we're going to be looking at this through the perspective and lens of a small business owner. A lot of the content that you're going to get online is going to be geared towards the individual taxpayer. And what we're wanting to do is give you the perspective of what it looks like through the small business owner lens.
Absolutely, yeah. And really, there's going to be some things we don't talk about, right? Like R&D credits and overseas income. Something we're trying to talk to small businesses. The most of you, married filing joint, S corp, partnership, sole prop. Not that these topics don't apply to everyone, just more of that's really the lens of how we're viewing it, because that's the bulk of the taxpayers that are in the United States and who we're working with. Awesome. So, as usual, if you have any questions, please feel free to comment them in the comment section below and we can see it, or shoot us an email at Info and Valley Taxes. And we have, I'll try to check my email for questions throughout the stream. We're going to be taking questions after each section, each topic, as well as the open Q&A at the end. So again, feel free to comment or ask your questions at any point, and we will get to it on that topic. Real quick, just a breakdown of what we're talking about today. We're going to go just summarize what's in the bill, talk about standard deduction and tax rates, then the interest and tax deduction, some of these itemized deductions, qualified business income deduction, no tax on tips, and last we'll end with depreciation. So just getting started, the TCJA was, the Tax Cuts and Jobs Act. That was the 2018 tax bill. That was actually the largest tax bill since 1986. So it was the biggest change to the 1040. It changed a lot of things. It lowered that corporate tax rate, but a lot of the provisions that we saw were temporary. And so obviously with the same administration, a lot of these new changes are taking these temporary provisions that they liked and making them permanent, as well as, some stuff expired. So whenever they are making a bill, what politicians love to do is, if they're testing the waters with a new topic, they're going to make it a temporary change that automatically expires. So there's a couple of reasons they do that. One, if the policy ends up being a failure, then it automatically expires and they don't need to worry about it, kind of just brush it under the rug. But if it's something that's successful, what they really like to do is put that expiration in an election year, whether it be the midterms or an election. And then they have, a chip to use. It's a negotiating ploy, kind of give some political power. So what you'll see, again, it's that TCJA, a lot of those things were set to expire. They won the election. They're making them permanent. And we've got some new temporary provisions. What you should know about that is the temporary provisions, someone has to vote on those to keep them going. Someone has to introduce a bill and say, hey, I like this, I'm going to endorse it, and I want us to vote to keep it. On the flip side, for a permanent change, someone has to come out and vote against it. They have to say, hey, I don't like this. We should get rid of it. And it has unless someone does that, it's going to be there permanently. Really all that to say, these permanent changes, you can plan on them being here for the long run. The only exception, and we'll run down this list of, there's a few things we'll talk about more in depth later. The lower corporate tax rate, that was a permanent provision in the TCJA. They were already talking about bumping that up. In this bill, it ended up staying at 21%. Out of everything, that seems like the most likely one to change for a multitude of reasons. First being people are often okay with voting to increase others' taxes, and C corps don't get a vote. When it's the corporate tax rate, we're talking about Nike, we're talking about um, other large companies, Walmart, that aren't based in Oregon. I dip to the well of Nike a lot because it's right down the street from us. These C corps, most of us are S corps. We don't even really worry about that corporate tax rate. But the QBID, that was made permanent. Bonus depreciation's back. That child tax credit was set to revert down to $1,000. It's back at 2,000, and then they added an extra 200, and it's going to be increasing with inflation each year. Estate and gift tax. I don't want to get bogged down in estate. If your estate's worth less than 15 million, don't even ask questions. You're good. And then individual tax rates. We'll talk about it a little bit, but again, they just made those new brackets and the rates permanent, and then some stuff with the standard deduction. As far as the new provisions, the one that we are not going to talk about later is that EV tax credit. So if you're looking to buy an electric vehicle, you want that $7,500 from the government. Just note that's going to expire September 30th. We just recently, my wife's lease came up, and we just got her a new car right before, so we could take advantage of that $7,500 one last time before that goes away. Awesome. Real quick, Trump accounts. I want to make this brief. If you did not have a kid this year, like I did, or in the next 3 years, this really doesn't apply to you. The history on this initially, when they were talking about increasing the child tax credit, the number they were talking about was about $3,000, and they wanted to give some incentive for newborns to encourage people to have kids. That ended up not happening, but the compromise was these Trump accounts, they are called Trump accounts. That's the official name for them. They haven't expressed how exactly they're going to monitor this, administer it. What we do know is it's going to be something that's not automatic. You're going to have to apply for it. It sounds like it's going to be on the 1040, so your personal return. But essentially, it's like a Roth IRA or a 529 plan. They're going to put $1,000 into the newborn child's account, and then parents can contribute $5,000 annually. It's going to grow tax-free. The one thing that's a little bit different from just doing a 529 or a Roth is, with a Roth, yeah, you can pay for college, you can pay for a home from that tax-free, but they don't have access to the full account until they're 65. This child has access to the funds at 30 years old. That's huge. That's when you're looking at buying your first house. That's when you're looking at maybe making some investments. So being able to take that money out of just, a brokerage account and being able to actually do something exciting and adventurous with that money, that is exciting. And I do like that they're giving it to the kids specifically. So, the parents get to manage it, but at the end of the day, that's going to be the kids' money no matter what.
Yeah, I had all my kids before 2025, so enjoy this one, Aaron.
I had one in 24 and then I had one in 25, so it's kind of a little unfair. It's like, well, one of you is going to get a way better tax advantage plan than the other, and I'm sorry about it. I don't mean to play favorites, but the government did. No, I think the one thing that I haven't really heard people talking about is, and I'm not, nothing in the government's altruistic, right? It's all someone's trying to get something. I think this was a big way to put more money into the stock market. Not saying that's good or bad. I'm just saying $1,000, that child tax credit that they were talking about giving to the parent. Now it's, hey, no, not only is it not going to the parent, it's going into an untouchable fund that's going to be in investments only. And there's restrictions on exactly what it can be put into. So, again, not saying that's good or bad. I think that's also a factor to take into account with it.
All right. Yeah, getting into one of my favorite topics now. I started doing taxes in 2016. So right before TCJA. That first year was the only year that I wasn't dealing with anything TCJA. And one of the things that I liked in 2017 was the standard deduction being increased. Now that has been made, well, it's been extended through 2028. And it's like Aaron was talking about these permanent versus temporary changes. The standard deduction essentially doubled in 2017, and we've extended that through 2028. The thing that I like about this for small business owners is we got to get creative about finding ways to take itemized deductions, Schedule A, off of your 1040 and put them onto the business and Schedule E. That way, we can still take the standard deduction and get some of the expenses that you were getting as itemized deductions through the business. Self rentals are a great example of this, where you can take your mortgage interest or a business percentage of your mortgage interest, your property taxes, your homeowner's insurance, which isn't even on Schedule A, and move that to Schedule E, where then we can deduct it fully from your income as well as take the standard deduction. And also, just to piggyback on that, the tax rates. Now they jumped up to 37%. You can see it's now up to, or the 37% rate cap is now permanent. And that 37% rate cap makes, that's at the top end. We see things where S corp owners that make $100,000 or less, that income is extremely cheap. So when you pair the cheaper tax rates with the standard deduction being doubled, you can find that the lower income uh, business owners, and I mean 100,000 and below, can really have cheap income.
Oh,
So now we move into spreading out income over years as opposed to having a high year and then a low year. When we can spread it out, it makes income extremely cheap.
certainly. Well, yeah, and that's where what you were saying. It was supposed to jump up back to 39.5. That's what it was before TCJA, but they
Right.
widened those brackets and then reduced the maximum rates, and they made that permanent now. So that's, obviously the brackets change every year; those are indexed, but the basis for that is at least permanent. So now it's gonna not set to automatically expire. Yeah, the
Yep.
last little thing with it is that bonus standard for the 65 and older. I mean, I think you were putting it perfectly earlier. It's really to get those people that are just living off Social Security that
Right.
extra bonus, right?
Yeah, and we'll dive into some of the Social Security stuff a little later, but overall, everybody's really wanting to get Social Security benefits to where they're not taxed. It's not happening. And this was the way that the legislation decided to help those people out, was give an extra standard deduction, so an extra $6,000 for 65 and older. And we'll dive into a little bit more of what Social Security has to offer as far as what the taxability of that is going to be. But yeah, this really is meant to help people who are living off of Social Security. Here's a little extra tax break for you. Cost of living continues to go up. You're on a fixed income. Let's make things a little cheaper for you.
Yeah. Oh, and too, it's they phase it out. If you make 150,000 to 250 is when they phase it out from. So, this is really, it's targeting those people that aren't actively making income. You don't have passive income. You have, you're making your Social Security, living off the retirement, tax-free retirement is my assumption there. Um, so that's really who it's targeting, and it's gonna, it's temporary. This is one of those ones. It's set to expire in 2028. We'll see. That seems like one that's just ripe for not. It's kind of messy and it doesn't quite accomplish what it's trying to do. It seems like one that's gonna, you know, probably we won't see again, but we'll find out in a few years, won't we?
Yes, we will. Okay, so yeah, um, we noticed that, or we saw that. Sorry, give me 1 second here. Okay, yeah. So back in 2017 with the TCJA, we saw the introduction of SALT, and it's a limitation. What it does is it limits the state and local taxes you pay on your itemized deductions, Schedule A. And originally, this was at $10,000. In a state like Oregon, where we're paying income tax rates of up to 9.9%, pretty easy to hit that $10,000 limitation and pretty quickly.
Oh yeah, I mean,
Obvious, go
I
ahead.
think we have one of the top five highest rates in Oregon. I
Or
mean,
in the
not in Oregon,
States.
in the states. Oregon has one of the top five rates because we don't have sales tax. Like even, I mean, a state like New Jersey is a great example where technically their highest rate's like 10.75%, but that's only if you make over $1 million, and they have sales tax. So it's, Oregon, the marginal rate is 9.9. That kicks in at 250,000, and below that you're still getting charged 9%.
Right.
So it's a pretty heavy tax on everyone.
Yeah, and then on top of that, property taxes are not cheap either, especially in the Portland area.
Oh
And
yeah.
so it's easy to see where you could cap out 10K pretty quick. So what they've done here is they've expanded that to $40,000. And I think for most of our clients, that's a significant change
Oh
to
yeah.
where you're going to be able to itemize up to 40K of your state and local taxes. So you're looking at property taxes and your income tax is going to be the main players in that game. But that expansion is really going to help out a lot of people. And we'll dive into some workarounds around this that we've been using with our clients. But overall, this is a good move. I really like this one. I hated the limitation. I love that they've expanded it. Now, it is meant to benefit people that aren't making a lot of money, as our progressive tax system ultimately tries to accomplish. So there is a phase out from 500 to $600,000, and in that phase out, you'll see the limitation creep back down to 10 grand. So the more you make, the more this hurts you.
Yeah. Well, and this is, I think of people like my parents, or both my parents. They work on a W-2, and they have a house, so they're paying property taxes, they're paying income taxes, and they don't have a business where they can shelter any of these expenses, and they can't use some of those workarounds that you'd alluded to earlier. And that's really who it's benefiting. It's these people that are making less than $500,000, but you still have a pretty substantial amount of income tax, and those are the ones that were the most hurt with the $10,000 cap.
Right. Right. And to jump into another topic here that is one that I think has been very popular. The car loan interest deduction. Now, this doesn't apply to just business owners. This is for everyone. And the idea is, uh, if you are paying interest on a financed car, let's get you a small tax break. Now, there are some stipulations that you have to follow. This is an above the line deduction. So, regardless of if you itemize or not, you can take this deduction if the car was assembled in the United States. It must be a new car and under $80,000 for the purchase price. And then there's a $10,000 cap to it. Now, cars that are running 80 grand typically won't have interest of too much more than $10,000 a year. But there is an expiration on this in 2028. So Aaron pointed out to me that some of these loans are going to continue on while this will expire, and those taxpayers will no longer be able to deduct that auto interest, which
Yeah, I mean the benefit is at least they're going to cash in when the interest is higher, right? Interest
right.
is higher at the beginning of the loan than the end, but it's kind of that it's like, hey, buy a new car, you'll get to deduct your interest, and then let it expire before the loan's over. All right, just kick the can. Don't think about it in 4 years when it comes back to bite you.
Yeah, ultimately, this is I think more of a PR move, because really, when we're talking about tax savings, this is not a big player. It will be a benefit to a lot of people, and I say take advantage of it if you can, if especially for small business owners. If we're not deducting the car through the business, then absolutely get this deduction. There's no reason not to, but it's not a big needle mover either. It's going to
Yeah,
save everybody a few $100s in tax savings.
yeah. I think, and the cool thing about it, I like that they didn't make it an itemized deduction. The fact that they put it
Right,
above the line, that's what we say. That's just right off your income. It doesn't matter if you can take the standard deduction and still take this. So I think that
right.
that will help a lot of people.
Hmm.
But this is very obviously trying to incentivize people to buy U.S. made cars. We'll see how much it actually moves the needle.
Right.
Uh, they got rid of the Camaro. They bring back the Camaro. I'll buy a U.S. car again. That's what you need to do, GM. I don't know if they're watching, but please bring back the Camaro. You killed my favorite car, and I'm very sad about it. Awesome. So Tim was alluding to it earlier, these workarounds that we have to that SALT cap for business owners. So specifically, if you own a pass-through entity, that's going to be S corps, partnerships, sole proprietors. Now, this was a big thing that a lot of states have very similar programs. I'm going to talk about Oregon specifically because I'm from Oregon. I know it like the back of my hand, and a lot of people here from Oregon and deal with it. But just know if you have income tax in your state, you probably have pass-through entity. Elective tax is probably pretty similar. But basically, that 10,000 cap, as we were talking about, that stung. So what a lot of states did is they made this election where you can say, hey, I'm going to pay an elective business tax. You're not forced to pay it, but you can. And that income tax is, oddly enough, pretty close to the personal income tax rates. You pay it at an entity level. You're paying a business tax, so that is federally deductible at an entity level. And then on the personal side, they go ahead and give you a credit for every dollar of tax that you paid. Really what you're doing is you're pushing some of your personal tax liability onto the business return. So you're still paying the same, well, for the sake of ease, you're paying the same amount of state income tax, but you're getting to deduct it on the federal, and you weren't before. Now, the cool thing about this is it's not just if you itemize. Like, you can take care of, like, there's plenty of people we have that took the standard deduction and then did the PTE elective. That's what's great about it, is you can double dip. Now, obviously, the people that are itemizing were taking advantage of this because they were most likely getting capped out at that 10. When they first introduced this, I mean, Tim, you know, the PTE is one of my favorite things to talk about. This has been my favorite tax. Oh, lost our connection there for a second. We're back.
Yep, we're back.
When they introduced this, part of me was bummed because I was like, man, I spent a couple of years really pushing this and learning it, being great, you know?
Yeah.
Now, I want everyone to save money, but at the same time, it's like, well, that had to have been for something. The more we dug into the SALT cap, it's really a lot of the people that we were doing the PTE for before are going to continue to be doing it because it's very specific, the ones that don't, this change makes it not worth it. Because you need to be taking itemized deductions before your state and local tax considerations. You need to be making less than $500,000, total local tax less than $40,000, and you don't have depreciation on your business. If all four of those apply, then maybe at that point PTE doesn't make sense anymore. If just one of those applies, specifically depreciation, you're going to still be benefiting. And honestly, too, a lot of the people that are going to be benefiting are these people that are the higher income. You're making over 500. You're going to have, not only are you phased out, but you're paying more than 40,000 in state and local tax.
Right.
It's a great. I think it's my favorite tax deduction, and it's my favorite topic because it's one of the very few strategies where the more you make, the more you save. Everything else, there's limits, there's boundaries. It's, hey, even with an S corp, it's like, oh, after this amount, you stop getting extra benefit. No, the SALT or PTE and moving around that SALT limitation, every dollar you make, you're saving more. It's a great deduction. It's a great program. And, if you want to know more, and I haven't talked to you about it yet, please get me on the phone. I'll talk to you about it for an hour.
Right. Well, we've heard from multiple clients that have come from other tax preparers, and we've talked to other tax preparers as well, that the juice wasn't worth the squeeze on the PTE elective. And for us, it's one of the most powerful tools, especially in the state of Oregon.
Oh,
When Aaron talks about the SALT limitation really kneecapping people, it was real, especially when you've got $100,000 of state tax liability. Being able to move that off of Schedule A and into the business as a, a business deduction, that was huge.
I think
So,
what was my record? I saved someone 60 grand on that. Just that.
yeah,
Yeah,
right.
that was a fun day.
Yep.
Giving
Yep.
someone
And
60 grand, they become your
yeah,
best friend.
yeah, that's a good one. That's an easy call to make.
Easy.
Um, But yeah, the biggest thing, even with the changes, even with the cap going up to 40K on salt, PTE is still very much relevant. And if you haven't been talking to your tax preparer about this, please bring it up to us. But our clients already know, and we've already been pushing it hard.
Absolutely. Yeah. I want to move on to another topic that we've talked about. Well, we don't really talk about it a lot, right? Every one of you is taking advantage of it, but it kind of just flies under the radar because it's not an election, it's not a strategy, it's just a cool little thing that they introduced with the TCJA, and that's qualified business income deduction. What it is essentially is it's just trying to reduce the tax liability on small businesses. It's a really complicated calculation. I'm not going to get into it. It's boring for you. I have a worksheet that does it for me. I don't manually do it, so I don't want to manually do it with you guys. But really, what it's trying to do is incentivize small businesses that employ other people, and they're trying to generate jobs. That's the whole point of QBIDs. They're trying to generate job growth. And so it was a test. That's what we were saying. It was one of those temporary provisions from the 2018 TCJA, and it was set to expire after this year. Now, we were telling people, hey, it's going to expire, plan for it to expire. And when we said that, Tim, you and I even both were like, I don't see how they don't renew this, because
Right.
it's really popular, and this is the other thing. It's really subtle, and people don't know about it. So, people just saw their tax bill go down, cheered. Well, when that went up, people were about to get really upset, and that was going to be a lot of
Yep.
fun conversations for us.
Right.
The benefit of this passing is we don't have to spend the 6 months at the end of this year prepping people for 2026. So I'm glad that they made it permanent. I don't got to make a series of videos about it. One of the cool things, though, is going into 26, I had a feeling they were going to renew it. You and I both did. I was shocked to find out that they increased it to 23%. I think that's
Yeah.
great. It's a little bit. Hey, every penny that they're willing to give us, let's take. I'll be grateful for every penny that we can reduce in tax. It's a great, easy deduction. The other thing, and this is, SSTB, if you see that there, it's a specified trade or business. Sorry, specified service, trade, or business. So that's really any business where the name of the owner is the core of the business and its core marketing standpoint. Specifically, they talk about attorneys, doctors, and CPAs, but it leaves it open to anyone who's, your entire business is based on your own name. And the reason that they put in these limits is because, again, it's trying to create jobs. So they don't want someone, hey, you're a public speaker, you're going around making $1 million and you're just going to get a 20% deduction. It's like, no, they want you to be creating jobs. So with that, just with the thing I like, because it affects me the most,
Right.
the phase out, the introduction stayed, but they moved the phase out cap. So now it phases out slower, So,
Hmm.
if anyone hits that number, I hope we hit that number someday.
Yeah.
It takes it, makes those specified service trade or businesses not hit as hard. The thing I don't like about it, Tim, I don't know if we talked about this earlier. I think about like doctors or accountants. If you're making that much, you have employees. you
Right.
know, that's the
Yes.
thing is, so it's like accountants and doctors got called out specifically, and it's like, well, if you're making that much, you have to, like, there's no way you're doing that on your own. You have a team. Why are you
Yeah.
punishing us? I get it. I get it.
Yep. Well,
Accountants.
go ahead.
I was gonna say accountant. They IRS and the government. They love to. They don't care about us. They don't listen. We'll talk about it in the no tips and tax. I remember during COVID, they were like, "Hey, by the way, it's March. I know that you've probably done half your returns already. We're changing the form." It's like, whoa, middle of tax season, really,
Yeah.
really, insane.
Y-
Why are you doing
Yep.
that?
Yep. No,
We
and the
chose this
QBID,
willingly.
QBID is absolutely, it's a great deduction. It's all the profit that you get from the business, you get to deduct a certain amount off of your income.
Oh,
Great. I love the principle. I love the idea of it. I hate the phase out, but the more you make, the more you're going to pay and the more you're going to get hit. So that falls in line. It makes sense. And yes, we continue to be the enemy of the IRS. And it's not that we chose this fight, right?
yeah. But oh, and I don't know if we talked about this. It's permanent now, so someone's going to have to come out against it to get rid of it. Whew, I don't see that
Good
happening.
luck.
It's
Good luck.
going to piss off a lot of small businesses, a lot of them. And again, we've been talking about this phase out. Probably shouldn't have talked about it as much. I just, I care about the things that affect me. Most businesses, if you're construction, anything that where, I mean, it doesn't matter if your name's in the company. It's like, if it's not a service that you are providing specifically, again, it's most businesses, you're not going to have the phase out. So you just get the
Correct.
great little deduction.
Yeah, and I think that's a good segue into the no tax on tips and overtime, because a lot of business owners have been talking about, okay, you want to say no tax on tips or overtime. All I make is tips and overtime. This is really meant for the employees and the benefit of W-2 workers specifically, not business owners. There are many ways that we can get aggressive with lowering your tax liability legally and as much as legally possible. This is not a situation where Aaron and I are going to tell you to get aggressive. It's meant to take everyone who works a job where they are getting tipped, and it's completely at the discretion of the consumer and the service that was provided them, and those that are working hard and are asked to work overtime. The government is saying you get to take a little bit of a break on those wages, and you won't owe any tip or on any taxes on tips and overtime. That's the intent of the law. uh, and that's what they're going to enforce. We do suspect that people will try and take advantage of this, and then they will be made examples of. But ultimately, this is really just to benefit people that are working hard and they need a bit of a break.
Yeah. Well, the key to it is the IRS has come out and said they don't know how they're going to enforce it. We've spoken.
Mhm.
I have to guess that there's a change to the W-2 coming, because I don't know how else people are going to report this on their personal returns. And it's not really a business owner. There's no tax change for them. But I do think there's going to be an administrative burden, because now we have to be very specific about how we track tips and overtime pay. And I mean, you were talking about people are going to try to get cutesy with it. I mean, they've talked about tech industries have been trying to, how can we abuse this and poke the loopholes? The first thing I said, Tim, when I heard it was, what if we just put a required gratuity on every tax invoice we send out as a way to give our employees a raise, make us more competitive? I can already see in their regulations that they will eventually come out with. I bet guaranteed gratuities won't get counted for that, right? Something like that. Or they'll put heavy limits on who and what industries can. It's going to be a
Yep.
mess. They haven't released how they're going to enforce it. Assuming that there's a W-2 change, you have to hope that they'd get it to us by November. But,
Right.
again, I mentioned it earlier. I think of COVID, where in the middle of March, they're giving us updates. It's like, whoa,
Yep.
and that's really something that we could see. And again, what you're saying, there's no reason to get aggressive with this. There's no real cutesy things you can do with it. There's no benefit for the business owners. Maybe if you're trying to be competitive and recruit employees, but I would rather just play it safe than be made an example of for the
Yep.
level of benefit you're going to get from this. I don't see
Right.
it. But
Yeah, I think more than anything, it will be an administrative burden on payroll companies
yeah,
to report it correctly and get it onto the W-2. But we'll see what they roll out with the regulation and how they're going to enforce this.
payroll companies like us, Tim,
That's
again, it
exactly
comes
right.
back to it. The IRS hates us.
Yeah,
They're going to find a way to make our lives just a little bit more miserable every day.
that's right. Well, okay, let's dive into probably the most talked about piece of this bill when it comes to our clients. And I would highly encourage everyone to go back and listen to last month's webinar that we did when we're talking about the 100% bonus depreciation. Uh, it's great that it's back. We all loved it, and it is a very powerful tool. I'm not surprised at all to see that 100% bonus is back and permanent.
I'm
And
shocked.
this is
I didn't think it was going to come back. I was like, this is too good to be. This is this is too nice. This gives us way too much flexibility. We're not going to be given this gift on our plates anymore. You know,
Yeah,
I'll take
no,
it. I'll take it. I'm happy.
absolutely. And in the context of our conversation that we had last month, yes, it's so powerful. It is such a powerful tool. Being able to wipe out whatever the cost of the asset is that you purchase off of your income in year one, it's fantastic. Now, it the nice thing about it is that the regulation also talks about Section 179 and increasing that deduction limit because sometimes it's going to make sense to spread those expenses out over a certain period of time as opposed to just wiping out all of your income in year one and then the next year getting hit with a heavy tax bill. We talked a little bit earlier about how these tax brackets are making it easier to show some income and pay really little in tax. So this slide right here is probably the most important one out of this presentation when it comes to our clients, just because the flexibility that it's going to be offering us for the foreseeable future is fantastic, and it's something to be really excited about.
Well, I like what you just said. It's flexibility because the big
Right.
thing I hated about all of the, without bonus depreciation, I've had a few clients, hey, I'm going to go buy this truck cash so I don't have to finance, especially when interest rates were high, 7, 8%. It's like, well, why do they have to spend 5 years? Like they paid for it. Shouldn't they get
Right.
to deduct it in the year they paid for it? Again, it's that flexibility. You can take it 100. Now, it's not always the best to take it 100. There's a lot of situations in which you shouldn't, but you get that flexibility.
Right.
Awesome. Well, I have not seen any questions come through. I think we went a little bit over time on what we planned, so I think that's fine. Real quick, I do just want to do a quick announcement. Our next webinar will be September 24th at noon. That is because the tax deadline is the 15th, and I didn't want to do one on the 17th. So it's going to be the 24th. I think we shoot for like second or third Wednesday, but this one's going to be a little bit later. The topic is TBD. So if you have a topic you want us to discuss, please shoot us your ideas. You can email, comment on this video. We'll take a look. I'm happy to discuss something if everyone is thinking something specific is popular. Otherwise, I'm going to pick what I want to talk about and what I like the most. I wish there was a football law coming out, start of the season. It'd be perfect timing.
NIL. We'll talk. We'll dive into NIL and the taxability behind it all.
I mean, hey, there was that executive order on NIL. I'm curious to see how that affects going into the next season.
Sure.
Did you have any last thoughts, Tim? Closing thoughts on any of the topics? Something we wanted to dive in a little deeper on with our extra time, or?
Well, I think what you see here is that even though this was made into a big spectacle, as most politics are these days, especially, there's really not a lot of changes that we're seeing, especially from 2017.
Yeah.
So it's more of a reinforcement of those things, if not a bit of an expansion. But overall, not much difference
Yeah, at least from the tax perspective. I'm sure
from
there's
the
some
tax
budgetary stuff.
perspective.
Yeah,
Yep.
budgetary, sure. I do think. I mean, on that topic, we'll get a little political here. This is probably. I mean, I said this after TCJA, so maybe this will age like warm milk. But I foresee this being the last tax cut we get for quite some time because this was quite the expansion. Again, as we were saying, a lot of those things that were made permanent, it's QBID and bonus. People love those. I don't see those going away, but I think I definitely don't think we're going to see this get. This is the golden goose we're given right now, so we got to use it for as long as it lasts.
Yep. So yeah, we're going to continue pushing S corps because that income is extremely cheap. But even C corps, the more that your business makes, the more it makes sense to be a C corp, and this is a primary reason for it, with the tax rate being so low. So overall, I think I'm happy with keeping things the way they are, as if not expanding these things a little bit. So I'm really not too upset about what the one big beautiful bill did to the tax system here. I
Yeah.
think it's good stuff.
It
and
didn't
we can
change
work
to
with it.
1040, so I'll take it.
Right.
Awesome. All right. Well, that seems like a good place to wrap it up. And we will see you all September 24th at noon.
Sweet. Thanks, Aaron. Good
Thanks.
work.
Talk to you soon.
All right.